when Al said, come on up to Jersey from Lancaster, Pennsylvania, and we'll get a couple real estate investors, real estate agents, maybe a couple insurance guys. Yeah, I was like, okay, whatever. I can, if that adds value to your program, sure. I expect to see like 500 of you guys. So good job coming out. Are you guys all right with questioning conventional wisdom? You all right with that? Yeah. Okay. And I am all yours for the next 70 minutes. So if you want to ask me questions in the end, you can. If you want to stop me and ask me questions while I'm giving my presentation, I'm good with that too. So my time is yours. All right. So let's go ahead and question some conventional wisdom and see where we're at on some of these subjects. So first one's education. You know, you think you got to go to college to be successful, and you got to get good grades to be successful in the real world. Maybe conventional wisdom. Food. If you go to the grocery store and you believe that you're going to have an FDA or USDA sticker on your food, you buy that chocolate cake with 80 ingredients, most of which you can't read, but it has that safety sticker on it that says you can consume it. It might be conventional medicine. You think that everything that's prescribed to you is to your benefit? You have a real problem there. And then you look at conventional finance, and you know, conventional finance has you working real hard, you getting a good grade, you work real hard, you invest your money in the stock market, and you hope that when you're 65 you can retire. That may be good. Maybe a little conventional. And then retirement. Your typical work 50, 70 years ago doesn't work today. So when I consider what I consider conventional is what's mainstream. So I can get that out of the dictionary. This is me. When I consider conventional is mainstream. It's typically easy to do. Everybody's doing it. And so when you look around and say, okay, is this conventional wisdom? Might be better off taking a step backward and saying, okay, let's think outside the box and see what else there is. You got 80% of the people on this side of the boat. Take a look around. All right. So that's sort of the context for where we're going to start at, and I wanted to talk about some non-conventional investment ideas as well. I was fortunate. I'm from a very entrepreneurial family. I'm from Lancaster, Pennsylvania, about 2.5 hours from here. I got up around 4 o'clock this morning to come up here. Those of you who live in this area, travel up and down 78, Interstate 78 and 287, you guys see a lot of our buildings going up and down the highway. We're heading up to the northeast. Our family is in the modular building business in Lancaster County. Lancaster County is the largest, it's the home of modular storage shed garages in the East Coast, probably in the entire country. But we're heavy in the modular building space. I've built some of these companies. This one is a family-owned business. I own that with my dad and my brothers. Some of these other ones, some of the other companies I started or partnered with people. And as I was growing up, I saw my dad, a very successful businessman. I saw my dad investing his capital in such a way that he parked it in real estate because he didn't know what else to do with it. I saw him self-managing. He bought some farms and land, and he bought some single-family homes. I saw him self-manage some of these single-family homes. Saw the good, bad, and the ugly, and I decided that wasn't going to be me. I was not going to invest in real estate. So I invested in these businesses. I got myself, had some real opportunities, had a lot of fun in this space. I was reading Jim Rogers' book, Hot Commodities. Anybody read Hot Commodities? There we go, at least one. And in the book, he was describing to me, Jim Rogers is one of the most successful commodities traders in the world. He was describing to me how to find value in a commodity. And he was telling me that when you see the cost of a commodity dropping below the price to produce the commodity, and in the commodity space that happens quite a lot. When the cost to purchase is lower than the cost, when the cost of purchase is lower than the cost to produce the asset, you may want to take a close look. Well, we were buying a lot of material, lumber, roof sheeting, saw the price of roof sheeting drop down below the cost to produce the sheeting, and he told me how it goes through this consolidation period, and then the big companies buy out the small mom and pop companies. And I was watching this whole thing go down, and at one point I remember telling my family, I said, we need to buy, and we need to buy a lot of this stuff. So we bought something like 50 truckloads of stuff. We had our warehouses packed full of roof sheeting. We had it stored outside. We had it tarped. Sheet of roof sheeting. We were buying it for around $5 a sheet. So we loaded up. Less than 2 years later, the price of the roof sheeting went up to $14 a sheet. That was so much fun. And it was so much fun not only in the fact that we made a lot of money, it was more fun because I called it right. And I called the timing, I called it right, and it was so much fun. I thought I was the greatest investor alive. What I did not realize until later, that's not investing. I was shipping buildings to all 50 states. I was a private money lender. I was flipping some houses, having all kinds of fun. Realized later that I wasn't an investor necessarily. I was a capital gains guy. I was a speculator. There's a big difference there. Having all kinds of fun. Didn't feel like work because it was so much fun. Didn't feel like work at all. I put in a lot of time and effort. I was burning a lot of calories, but it didn't feel like work. I remember the time I got the call from my CPA on April 13th, saying that, hey, we took all the deductions we could. We know we know you paid your quarterly payments, quarterly tax payments, but in 2 days you're still going to need to come up with $373,422 and some change. You're going to pay almost right around $500,000 in tax. All of a sudden, it wasn't so much fun anymore. When I realized that almost half of my earnings from my activities were going to have to go back to the government, it wasn't so much fun. There was a couple times in my life where I came across a statement that changed the course of my life, that stuck with me. I kept hearing this guy that drove me nuts. Make millions of dollars in income and pay no tax. What in the world are you talking about? I was raised on the fact that if you make a lot of money, you pay a lot of tax. My CPA said, oh, you had a good year this year. Yeah, you're not paying no tax. Pretty opposite. Well, you make a lot of money, you got to pay a lot of tax. How many of you believe that that's true? Or how many do you believe that's conventional wisdom? There we go. Make millions of dollars and pay no tax is what he was saying. It drove me crazy. I had to go find out what he was talking about. His CPA, Tom Norway, we heard about him earlier, my friend Damien, told me, this is another shocker, this is another time that I really got jolted awake. You want to change your tax? Change your facts. Change the way that you do business. Change the way that you invest. Change the way that you behave. So when I realized that it was up to me, everything changed. And you can take this out into the real world. You can take that out into the real world, and when you take responsibility and realize that it's up to me, things change. I realized that if I invest a certain way, if I do business a certain way, and if I do what the government wants, it'll change my facts. Let's get Trump's thoughts on tax. I'm not a political guy, but I found this interesting. Over here, you've got a high-paid professional. You've got a W-2 employee. Over here, you've got an entrepreneur, business owner, real estate investor. His thoughts on taxes, when he was being accused of not paying enough of tax, his thoughts on that was, well, that makes me smart. And I would agree with that. You know, non-conventional thinking, when you get your tax bill, and let's say it's a big tax bill, that's the government telling you you're not doing what they want you to do. That's your problem for not doing what the government wants you to do. All right? That's what our tax planning sessions look like. That's my CPA in the water. That's a group of us on the beach, a group of our investors on the beach, and we're learning about tax. There's another tax planning session. All right, enough of that. So some of you guys know what this feels like. There's people in this group, I'm sure, that are making 6 figures a year. Maybe some well into the 6 figures, maybe some in the 7 figures. You're making a lot of money, but at the end of the day, you're paying half of it back to the government. How's that feel? That used to be me. That used to be me. So what does the government want? I think this is a great question in that when you want to know what by the way, if you send me an email at the end and you say, send me that thing, I'll do it. All right? All right, done. Good. All right, so let's figure out what the government wants. When you follow the tax law, you can figure out, okay, this is where the government, tax is really all just a way for the government to funnel money where they want it to go, okay? So if you figure out, okay, here's what they want us to do, all you got to do is look at the tax incentives and figure out, okay, that's where they want the money to flow. They want you to create jobs. They'll reward you for creating jobs. They want you to provide housing. Anybody ever seen a profitable government housing project? So they know they're not good at it. They'll pay you to do it. They'll pay you to take the risk of drilling for oil. They know we need oil. But you've seen what happens when the government comes in and nationalizes oil in the oil fields. They know what happens. They'd rather pay you to take the risk. They'll do it. At one point, we had a solar system, a 375 kW solar system installed in our manufacturing facility, and we set my timer so I know where I'm at here. So we had this solar system installed, and the reason we had the solar system installed was because at the time they came out with a sunshine grant in Pennsylvania. It now became, they added another 30% of benefit to when you purchase a solar system. They were working on their renewable energy plan, and we bought into it. And at that point, it made sense. They paid us to do it. Do you believe that the government wants you to go out? The government wants you to go out and buy equipment. They want you to go out and support manufacturing. They want you to go out and spend money to enhance the economy. And if you do that, if you do what they want, they will reward you, and you can make millions of dollars a year and not pay taxes. So, make a lot of money, you got to pay a lot of taxes, and that's all right. So, I came away from that phone call with my CPA, and I knew that if I wanted to go in a different direction, I knew that if I wanted to take advantage of what was available to me, I had to find people that were doing it. Proverbs talks a lot about seeking out wisdom, seeking out wise counsel. I was, they say you can learn the most when you are in extreme pain or when you're experiencing extreme pleasure. And that was a painful experience. So I educated myself and I took action and surrounded myself with great folks. So I'm sure there's people in here, I'm sure a bunch of you in here. I was this guy. I was out there doing it on my own. In this business, you will get a lot more done if you have a really good team. So work on building your team. You guys all Giants fans up here? You guys Eagles fans? Yeah. All right. This picture was about a year and a half ago. So who is your team? I'm going to talk to you a little bit about how I like to do business. Most of the time, I'm doing business with a partner. I just like the idea of having somebody with gifts that I don't have, that you can team up with somebody that will bring value to your party that's more than just 1 + 1. equals 2. Maybe it's 1 plus 1 equals 3 or 4. So we're going to talk about your team, but then we're going to come back to the partner space. We're going to hit on that a little bit more. So you got a property management team. And say you're in the real estate space. You got a property management team. You might have a broker, a banker, an attorney. And let me just tell you that if you got good people on your team, you'll be able to have so much of a bigger impact. Those guys usually aren't cheap. The best guys usually aren't cheap, but they're worth it. If you got a really good people on your team, they will make you money. They won't cost you money. All right. I have partners in the ATM space. I have partners in the self-storage space. Partners in the energy space. I have a sales and marketing company where we connect buyers and sellers all over the country with modular buildings. And I just sold, about 2 years ago, a year and a half ago, I just sold a part of that company to my 3 brothers. I love doing business with partners. When I go to market looking for a partner in a certain asset class, one of the first things I do, probably the most important thing that I do, is I'm going to just turn that thing off and there we go. All right. You guys will let me know when I'm all right, so I'm much safer when I invest alongside of my investors rather than going out and invest on my own because I'm much more stringent on my rules when I invest with my investors. When I'm investing with a new partner, I'm doing background checks. I'm doing a lot of work and a lot of due diligence on those partners. One of the biggest things, one of the first things I look for is track record. So track record is very important in that I want to know what happened. I want to know what this guy's done in the last 10 years. Has there been failures? Great. It's not a problem. I just want to know what did you do? How did you work your way out of that problem, out of that issue, out of that failure? What did you learn? It's not wrong to have failures and challenges and problems. In fact, us as entrepreneurs, we know about it. It's part of the process. So I'm doing background checks. I'm looking for clues. I'm looking at their personal life. How do they treat how's he treat his wife? Is he faithful to his wife? You think if somebody's not going to be honest or faithful with his wife, they will be totally upright and honest and faithful with his business partner? Something to think about. Look for clues. And then test them. I like to give potential partners the opportunity to lie to me. See if they'll take it. Ask them a question you already know the answer to and set them up. And see if they'll take the bait. You know, is that being deceitful? Is that trickery? Maybe, I don't really think so, but I deserve to know. If I put my investors' money at risk, I deserve to know what this guy's made of. If you're going to do business with a partner, which I do a lot of, make sure that you pay attention to details on the front end. Make sure that you set it up correctly on the front end. When you're getting ready to go out and do some big wonderful thing and you're going to go out and make waves and you're going to make a big difference, it's all fun. It sounds like all sunshine and rainbows on the front side, and that's exactly the time when you want to put those details in place, when you don't think you're going to need them. Later on when you need them, if you ever need them, it's going to be too late to put them in place. Legal protection, if at all possible, especially when you get your investors' money at risk. Keep control. And then set up trigger events. If you're putting a deal together with a new partner, let's say you're doing a deal in a multifamily, I'll give you an example. Say you're doing a deal in a multifamily apartment complex, and your partner is the property manager, is also the property management company. You've got a deal like that. You've got a partner that's also my property management, my asset manager. One of the things that I am going through right now is my partner has got stage 4 cancer. And in our contracts, he's also my property manager and my asset manager. In my contract, it reads that I can get rid of him anytime I want, I can fire him as a property manager. But if I do, I got to buy out his share, I got to take him off the bank run, and then it's all mine. That was set up as a protection mechanism for both of us. It was set up for a protection mechanism for him and me. And now he's been going through this sickness, and he's got marital issues, and his wife wants what's hers, and it's a mess. And we're working through that right now. And I got an offer to buy him out right now, today. This is going on when I'm sitting in the back seat. I'm talking emails and reading through this stuff and trying to come up with some solutions and fighting for my investor. So this is important stuff. You know, if I'd have set up a trigger event that said, hey, in the event that you get sick, or in the event that for whatever reason occupancy falls to whatever, 70%, you're going. No buyout, no whatever, you're going. That would be a trigger event. So make sure you protect yourself, make sure you set up a trigger event. So in order for me to go from paying a lot of money in tax to paying zero tax and making more money in the process, I have to get creative. And for me, somebody mentioned it this morning about being a real estate professional. A lot of you guys know what that is. By the show of hands that you had earlier. For me, I knew that I had to become a real estate professional. Basically what that does, it makes what normally would be your passive losses, turns that into active losses. And now you can take your active losses in real estate and offset your active ordinary income. And I had a lot of, due to the businesses I had a lot of ordinary income that I needed to protect. So you may look at that and say, well, that doesn't work for me. I understand, it doesn't work for everybody. You may have a career that is on the upswing, and you know your total focus is on that career, and that's fine. I've seen people use this where they bring their wife in as the real estate professional. I say you're filing jointly, and your wife has, and you guys have sent your kids off to school, and maybe there's something where she can spend 15 hours a week looking over your real estate interests, shopping for real estate, traveling to events like this to learn about real estate, 15 hours a week, 750 hours a year. She could be your real estate professional. That is a big deal. Being a real estate professional, if you're a real estate investor and you're a real estate professional, you have ordinary income. That's a big deal. But it's not the only way. There's other options. There's you know, if you're a W-2 employee, there's options. There's just a lot fewer of them. Okay? So the way that I've got the momentum and the way that I was able to take my tax liability and make it go away was I became a real estate professional. I invested in apartments. I used cost segregation studies. I used bonus depreciation. And I was able to make my tax liability go away. But there's like I said, there's other asset classes that you can use to offset even W-2 income. Oil and gas, coal. We use a lot of captive insurance in our ordinary businesses, and we can talk. I mean, that's a whole other subject. There's people that can do a whole presentation on that. You can even get gifting, giving away money. You can even get really creative by giving away assets. I'm going to talk about this just a little bit, just to pique your curiosity and make you wonder what I'm talking about. I got together with my CPA. I wanted to give the gift of an ATM investment of $104,000, but I also wanted to get the depreciation for the asset, but I also wanted to get the tax benefit for the gift of the cash flow. So I was able to give away $178,000 cash benefit to an organization that I believe in for a $10,000 first year out of pocket cost. Gave $178,000 first year out of pocket cost, $10,000. Pocket huge tax benefit. So we can talk about that some more in the end, and when I have my email, you can ask me about that. All right, so let's talk about my four rules for successful investing. I learned this from a mentor of mine quite a few years ago. and it changed everything for me. It changed the way I looked at investing. My personal investment philosophy was I had to get control of my tax situation. So I'm going to market looking for a solution to a problem that I had. So at that point, I realized that real estate, which remember I wanted nothing to do with earlier, was not only a cash flow mechanism, it was not only an equity growth mechanism. I thought I could do better than that in business. But it was a real tax protection vehicle. So I went from not wanting any of it to wanting all of it. And so I went to market. I went looking for multifamily assets. I figured out, okay, multifamily is probably going to be the best leverage. I went looking for a market that would deliver cash flow. You get depreciation anywhere, but I was also interested in cash flow streams. I selected a team in that market, and then I let that team, I got that team to help me find a great asset. I remember a number of years ago, when I first used this strategy, I knew I wanted access to I knew I wanted exposure to the San Antonio market. So I had friends that were invested there. So I asked my friends and said, hey, would you introduce me to your team? They were kind enough to introduce me to their team. I got on the phone with the property management team. Notice I didn't say the broker. Property management team. Anybody pick up on that, or why that would be important? Why would you talk to your broker or your property management team rather than your broker to go find an asset? Property management team.
They know when they're going to sell.
They have to manage that asset after you purchase it. And so they're interested in putting good quality assets in their portfolio that they want to manage. So I said, okay, Mr. Property Manager, if I was to come to your market and buy in a certain area of town, where would you send me to purchase an asset that you would love to manage? So I said, I got exactly what I would love to manage. He took me to a brand new development where they were building fourplexes. Back to my personal investment philosophy, I was not Freddied or fannied out, and I wanted to maximize the Fannie and Freddie programs. So I bought a couple brand new fourplexes, and I still own them today. And almost forget that I own them, except once a month I get a check. And so this works. This really works, and most people do it just the opposite. Find the asset. How many of you know that the asset that looks best on paper is usually the one that's hardest to keep filled? Like, you can go down to the hood, you can find this 4-unit thing, and you can fill it up, and oh my goodness, that thing cash flows. We can keep this full and collect the rents. This thing will cash flow 30% cash on cash return. And then you go find the team to manage the asset, and they're like, oh my goodness, that's not the tracks, you know. So most people do this opposite. Just that has worked really well for me. Benefits of real estate investing. You know, this in area of importance. This was my number one. This was my pain. I needed this. I was willing to go neutral on this in order to get this. But you know what happens? Once I get this under control, now this might change in order of importance. Let's get out of that under control, then you can think, oh, okay, let's build up some cash flow streams. Let's build up some more cash flow. Let's build up some more revenue streams. And then later on, you may be in this camp. You're like, okay, we got the cash flow figured out. We got the depreciation figured out. Let's build some long-term equity growth. Let's build some legacy stuff. So this stuff will change, but there's some of the benefits. And just be thinking about what's important to me today. And then once you get that down and you're running with that, you can always adjust this and take another approach later. One of the things that's important to some people is to be able to drive to their properties, keep them within 10, 20, 50 miles. I will tell you that if you got great management, if you got a great team, location doesn't matter. The house on the left, 6 miles from my house. I was in it twice, I think. I bought it in 2010 and 9 10 from the bank. fixed it up, tenant moved in, never met the tenant. Drove past it twice, 2-3 times. Sold it about 3 years later and almost doubled my money on it. But the monthly cash flow, I think, was around $300, $300 or $400 a month. This building is in Baytown, Texas. This is the building on the left on steroids. I mean, this thing just cranks out cash flow. It's less work. Got a great team. You know, and you can. Somebody was talking earlier about scale. I mean, this is the way you scale, and it's not any harder. Location doesn't matter if you have a great team. The other thing is, bigger is not always harder. How many of you know that getting a loan from this guy for, let's say, $300,000 or $400,000 is harder than getting a loan from this guy for, say, $3 or $4 million? Yeah. There we go. I can tell you a story about how I went through the whole single-family home purchase, and it was 5 times harder to get that loan, and then you needed 5 times more information to get the loan through for a $400,000 loan compared to what it takes to get a $5 million loan. But bigger is not always harder. In fact, most of the time it's easier. So I got into, I had a tax problem. I got into the multifamily space, and I bought several hundred units of my own, and I used leverage. I used cost segregation, and I finally got to the point where I got momentum. What happens is when you pay half the money that you make back to the government, that is money that you could be investing into assets that give you lots of depreciation, which then makes it so you don't have to pay tax the next year, and it creates this sort of momentum, this snowball effect. And finally got to the point where I had the momentum. I was able to reinvest the cash flow that I was making from my active businesses, from my real estate, and I used debt and taxes as my friend. Here's one of the reasons we really like investing in multifamily or assets that give you lots of depreciation. This investor invested $100,000, and first year tax deduction, $91,701. He was able to almost write his whole investment off in year 1. That's why we like real estate. I got to the point where I had bought a couple hundred units of my own, and I was out of money. I was out of cash. And about that time, I was invited to sit on the board of a local startup bank. This was a bank that there was about 12 of us. We got together and we met, and we were sitting around this table. We were talking about the money that's needed, the startup costs, and the capital that's needed to come in to start up the bank. And I was sitting with these 10, 11 other guys, and I knew most of them personally. I knew they could write 7-figure checks, and I heard conversations, little side conversations like, well, should we invest in the bank? Probably going to be 5 to 7 years until we see any kind of return. But I guess it's better than keeping our money in a CD. 0.02% at the time. The light bulb went off in my head. It was like, I'm making double-digit returns in apartments, and these guys are making business decisions based on a 0.02% CD. So, my next multifamily project, I went to some of these guys, and I don't know if I knew how to spell syndication at the time, but I raised the money to go purchase an asset, and we did that deal. Basically, we did a syndication deal. For you guys that aren't familiar with that, is sort of how this works, or one of the ways that you can make this work. And you don't have to do it just multifamily self-storage. You can get creative. I've done syndications, and we bought out a book publisher. We've financed uranium company. We've done all kinds of fun things with syndication. So you can think outside the box. A lot of people, when they think syndication, they think, oh yeah, apartment building, bring 10 guys, 20 guys together and go do it. You can syndicate anything. So syndication is all about solving problems. You've got investors who have problems. They got low yield opportunities. They got few options. They're busy running their own business. I had a problem. My problem was I bought several hundred units of multifamily apartments. I was out of cash. I was in a vulnerable position in my mind I had the #1 broker in the city who was calling me first. Wanted to keep that position. So in order to do that, you've got to perform. You've got to keep buying. So I had a problem. My investors had a problem. And we were able to come and solve the problem with syndication. Some of the creative syndications that we've done, this is a 42-unit office park. We bought this property, and I knew that I was going to have, we had 2 different 1031s come into this deal, 1031 exchanges, and I knew that we were going to have way too much money, way more money than we needed to close this deal if we bought financing on the front side. So we purchased the building. I said, wait, we got the financing all lined up, hold that. We bought the building, and then within 30 days, we brought in financing and returned almost half the investment cash back to them. So it's a way that we protected 1031 exchanges for the 2 investors who came in with $250,000 each. We were able to protect that, keep them tax-free, and then turn around and return half their money back to them. So you can get creative with this stuff. We love ATM machines. We are the, I believe, 6th or 7th largest operator in the country. And we're going to go through a couple of these assets. And the reason, I want to show you a couple of these assets, partly because I want you to see how we think about an asset and why, and some of the components that are important to us. Okay, so you got strong double-digit cash flow. That's good, right? You got most of the cash flow is tax-free because of depreciation in the equipment. You get to write off the income from that asset, or for the income from the investment. So we take the depreciation over 5 years. So 70 to 80% of your income coming from this asset class is tax-free. It's totally passive. You get to write off the whole investment in 5 years. Okay. And the reason I want to show you some of this stuff is this is some of the strategies. Investing in these assets are some of the strategies we use here. Now I got from paying hundreds of thousands of dollars a year in tax to paying 0 in tax, all while doubling, tripling my income. We love self-storage. The reason we love self-storage, lots of appreciation potential. You got your depreciation piece, you got cash flow. One of the things I really love about this asset class is historically it's been recession resistant. This asset class does really well in times of uncertainty and disruption, in times when people are downsizing, people are getting laid off, people are moving, people are getting divorced. Any kind of times where there's disruption in the marketplace, this asset class has done well historically. And I was looking at this space for a long time before I met the operators, before I met a team that I wanted to do business with. I'm involved in an energy project down in South Texas where we run coal through this unit. We can run coal through this unit at 1600 degrees. We can do it in a way where we're not releasing any emissions into the air. So we're extracting liquid from the coal, and we're selling it to Exxon. We got contracts with Exxon. And they will take all of the coal, this is a shale oil play. So we're really using coal to get what we really want is the shale oil. For those of you know what the tax benefits are on coal versus shale oil, or shale oil in general, it's one of the best tax advantaged commodities out there. We like this asset class because it's got super strong cash flow. It's got first year bonus depreciation. You can write off the asset in the first year 100%. You can take the tax deduction against ordinary income, W-2 income. And then you've got your depletion. If you take 100% of profit, if you take 100% of gross sales, and actually it's better than profit. If you take 100% of gross sales, you can take a 15% depletion on gross sales. So you're really only paying 85%. You're you're paying taxes on 85% of the income after you've taken 100% bonus depreciation. So and that's on an annualized basis. So really tax advantageous. Talk to you about teams. We talked about teams earlier. Talk to you a little bit more about teams. Great teams allow you to be bold. They allow you to play offense. We get aggressive with, I'll give you an example. One of our multifamily projects, we talked about, Ryan talked about NOI. On one of our, we've got a 286 unit multifamily building that we added remember we're in the modular building business? We added a 5-unit self-storage building, 6-unit self-storage building, 5 or 6-unit self-storage building for around $13,000, and filled it, and the cash flow from that unit gave us a valuation on the project of $73,000. We spent $13,000 to get the $73,000 in value, and we're providing the extra cash flow to our investors. Okay, so it allows you to take calculated risk. It allows you to be bold. These guys, we've got a small team. It's a very deep team. It's a team that's got more than 80 years of combined ATM experience. But we're small, we're nimble. Yeah, we've got over $100 million of ATM machines out in the street, but we're still considered small, and we're nimble enough. We compete with private equity firms and hedge funds, and we win. That's what you can do with a great team. So build your team. All right, build your team. Here's some of the performance of my self-storage team. You can see some of the highlights there. Average internal rate of return, 49% annualized. Equity multiple, more than 3x. So that's what you can do with a great team. And that's on the last 19 units sold between 2014 and 2018. That needs to be updated because it's 21 now, which the numbers are quite similar. We teamed up with this operator in the residential assisted living space. This guy's got 5, talk about track record, this guy's got 5 residential assisted living facilities, and they are 100% occupied with a waiting list. This guy knows how to run residential assisted living. We love teaming up with great operators. Let's talk about passive income a little bit. Warren Buffett says if you don't learn how to earn while you sleep, you will work till you're dead. All right? So here's another one. It fits right in with that. We'll get that done. We'll get to that one later. I thought it was in here. Uh-oh. Boy, I look screwed down. All right. Since it's not in there, I thought it was. But since it isn't, I'll tell you what it says. I think I'm almost there. How do you do that? All right. There we go. Okay. So we'll talk about that slide in a minute. So I had the other slide in here. We good? All right. So I'm going to get it close. I think I got it close. So working for only a paycheck. Let's say, and it's not a matter of working for a paycheck, especially when you're starting out. It's not a matter of working for a paycheck long term. This is not work only for a paycheck. If you work only for a paycheck, it's like playing Monopoly. What did the slide get to? Dropped out of it. If you work only for a paycheck, it's like playing the game of Monopoly and only collecting $200 every time you go past go. All right? You're not collecting passive income. I've got some of my cash flowing assets listed there just to give you an idea. I love diversification. I love doing business with different teams and different asset classes. If you do this right, you invest for cash flow, and you do this right, you can make millions of dollars per year tax-free in the U.S. I was at this, I was asked to speak at another investment conference, and the speaker was telling me about how he flips houses, and he flipped a whole bunch of houses from 2010 to 2015, and he moved the way that he invests. I was in Puerto Rico, and I don't want to live in Puerto Rico. You can do this stuff and live in the United States. You can make a lot of money and not pay any tax. You just got to educate yourself and you got to take action. You don't have to move to some island and live where you don't want to live. You can live here in the U.S. and do this stuff. So, get comfortable with being uncomfortable. I don't know what happened. There's a couple slides in here that I'm missing. But I would say for brand new investors, if you're looking to start out and you're collecting the paycheck, but you want to add to your asset column, you want to get to the point where, I think personally your ultimate goal should be at some point, you name the time frame, it could be 5 years, 10 years, 15 years, 20 years, whatever. I think at some point your passive income should exceed your ordinary income. You know, you can set the time, whatever that time is for you. But at some point in your lifetime, if you want true financial freedom, I think your passive income should exceed your ordinary income, your active income. And is it going to be hard? Of course. But it's not as hard. I mean, it's going to take discipline. Jim Rohn says it's going to be painful. You're either going to have the pain of discipline or you're going to have the pain of regret. You know, if you play this game right, if you do this right, if you put into you commit yourself to the process, and you put in the discipline, you can live. You don't have to worry about what you're going to do when you're 65. Yeah, they're not offering, full pensions most places anymore. But if you do this right, if you commit to the process and you add a cash flowing asset to your asset column every year and get to the point where your passive income exceeds your active income, that's a good place to be. And it's not always going to be easy. Get comfortable being uncomfortable. Push yourself. Ask the question, how can I? One of the questions I keep asking myself when I run into, I'll give you an example. Our shale oil play. We designed that. I asked the question, okay, how can I get this to the point where we can offset ordinary income? It's very important. Because I do a lot of business with high-paid professionals. I do a lot of business with dentists, doctors, lawyers, CPAs. So we designed it in a way that we could offset ordinary income. And then we designed it in a way that where we're not calling it, you can go either way with this. You can call it a coal investment, or you can structure and design the whole thing around shale oil. There's a big difference. You get to take 15% depletion. You get to take 15% depletion on the raw product that's in the mine when you call it a coal investment. Or if you call it a shale oil investment, you get 15%. You get to take 15% depletion on the gross sales. It's a big difference. So when you ask yourself the question, you want to get to, okay, so you're here, and you want to get to here, you got to ask your question, how can I? You pay hundreds of thousands of dollars in tax. How can I? Conventional wisdom, the easy way to do things is to say, oh, well, this is just how it's been done for a long, long time, and this is, everybody's doing this. Well, that's conventional. Okay, so think outside the box. And just remember, most things that are worthwhile are seldom easy. It takes effort. It's hard. You got to educate yourself. You got to take action. But it's not as hard as trying to figure out, okay, how are we going to get enough money to send my kid to college? How are we going to make that house payment? How are we going to do this and that? How are we going to get that really nice vacation? It's not that hard. It's hard. It's not that hard. And then life rewards action. You get out there and do it. And if you're active and you're working hard and you're making, not only working hard, but working smart, life rewards action. Get out there and take action. Life rewards action. All right? My friend Tom Hopkins says, use money and love people. Never use people and love money. All right? Tom's a great guy. I love that quote. So, I've got information on self-storage. I got information I got to write up on ATMs. I got a little booklet here that I wrote up for you guys that are interested in being a syndicator. So, to the guy in the front row that I mentioned earlier, if you want that slide deck, just send me an email. All right, so if you guys send me an email, someone on my team will respond, and we're happy to engage and talk to you about the different asset classes, talk to you about different tax situations. I am not a CPA, but I have a really good one, and I talk to them a lot. And we've been able to help investors save taxes, save on their tax liabilities. One of the most favorite things I get to do is not just sell an investor an asset or an investment. It is planning and getting the plan, especially when we're coming down toward the end of the year where we sit with an investor and you realize that not only are you getting him into a good cash flowing asset, but you can reduce his tax liability. And if you do it aggressively enough, you can not only reduce the amount of tax that he has to pay because you invested in a depreciating asset, but now you even get him to the point where because you dropped his income by using depreciation, you now dropped him into a lower tax bracket. So it's like a double-edged sword. It's a lot of fun. So, love to talk to you about that, and we will engage with you if you send us an email. I am, how much time do I have? All right, we got 10 minutes for questions. So, fire away, I'm all yours, and all yours.
The real estate professional designation you're talking about, is it realistic that a W-2 employee also do that on the side to get that?
It's possible. There are some very clear rules around being, okay, so the question, everybody heard the question. The question is, can you be a W-2 employee and also be a real estate professional? The question is, yeah, or the answer is yes. You can be, but there's some very clear rules around what it takes to be a real estate professional. Number one, you got to have 750 hours, which is, that's the easy work, 15 hours a week. But it's also got to be your number one activity in the form of time. Like you couldn't put 15 hours a week into real estate and then 18 hours a week into your W-2 job. It's got to be your primary, it doesn't have to be your primary source of income. It has nothing to do with income, it has to do with time. So you got to put more time into real estate than any other activity. So, you know, like I said, some people it doesn't work for. Look at your wife and see if you can leverage, you know, get her to leverage that. But it is a powerful tool. It's a big deal. From a tax perspective, it's a big deal, especially if you're a real estate investor. Yes?
What are the characteristics you're looking for when finding...
Sorry, I can't hear the question.
What are the characteristics you're looking for when creating a deal for self-storage? What are the characteristics you're looking for when you're creating a deal for like self-storage?
Sorry, repeat that.
What are the characteristics you're looking for self-storage?
How do you analyze the self-storage deal, for example? If you buy a complex or apartments, you have a lot of sources like MLS and stuff, occupancy rates. But here, how do you analyze except of the selling only tells you what about
there's a number of key metrics. It has to do with heads in a certain square mile area. You get a certain amount of people in a certain amount of square miles around the location. And I leverage my team. They have a whole list of metrics. Has to do with traffic count. Has to do with rooftops. Has to do with jobs. And they've got a whole list of criteria. I'm not part of the acquisition team, but we got a guy that does only acquisition. We find off-market deals, and these guys are in this space. I mean, one of the guys earlier mentioned 10,000 hours. I think it was Damien mentioned 10,000 hours. When you can partner with someone who has their 10,000 hours, one of the things I asked these guys, one of the things I asked this team, and we've now done 5 different assets with them in the last 2 years. One of the things I asked them was, what else do you do? Like, you invest in apartments or oil or what else do you do? Self-storage. 35 years. That's all he's ever did. He's got his 10,000 hours. So there are key metrics like traffic count, like people, per household. There's got a certain amount of people in that square mile area where it's either oversupplied or undersupplied. But those are some of the metrics that they use.
So tracing back when you started, syndicated your first deal, let's say, would you line up your investors first and then find your deal? Because it's kind of tricky, right? The timing of having your investors lined up because you're in contract now, and then you have to, once you're in contract, you need to be sure your investors are committed. So that's actually the biggest knot in all of this that this mystery.
So I've never raised money for a project that I didn't already have the deal identified or under contract. Now that being said, I'm always talking about it. So I'm out talking to people, they know it's what I do. They may come to me and say, hey, when you get your next deal, call me or send me the deal, or I want to take a look, or So I'm always talking about it, but we never raise money and then go buy the asset. It's always we put the asset under contract, then I go find the money. You can raise, you don't have to do it in that order, but I will tell you from talking to different folks, some who've tried to do it that way, where they raise the money and then go find the asset, it's a lot harder. If you have an asset and you've got a story around that asset, because that's what's going to sell, it's the story. The property is here, here's what you're going to do to it to get it to here. And you build a story around it. You can build a story around it, and you can point back to that track record. When I first went to market with my very first syndication, I bought a couple hundred units prior to that. So I was able to point back and say, okay, this is what we've done. It's a lot different than saying, this is what we're going to do, this is what we've done. Here's what we think we can do with this property, we take it from here to here. And if you can build a story around that, it becomes a lot easier. Yes?
In your process to select your team, when it comes to managing property that has multiple states, do you typically look for a company that has the capability of managing these properties in different states, or do you find a property management company first?
It depends. The question was, when you go looking for a team, does that team, do you have a team that's just in a certain area, or do you have a team that goes out and manages multiple states? Our self-storage team manages multiple states. I've got two different partners in the multifamily space who they manage in their city, and that's it. Not only do they just manage in their city, they just do BNC class multifamily. So it's a very tight niche, very tight market, but it depends. I mean, if I find, I'm not opposed to partnering with someone who is more diversified and has the ability to manage outside a specific market. But at that point, it becomes very, very important to see, check the depth of the team. You do not want to get into a situation where your team is scattered and you got too many balls in the air and you're running to and fro, and you got to make sure that your team is deep and that they're capable of doing that.
What are the main criteria that selecting, let's just say, the property management? What are your key things to focus on?
Probably for me, the top two are track record and referrals. Now, when I say referrals, I'm not talking about going to them and getting them to send me a referral. I'm talking about people in my network who I've known and who've invested with this team. I'll just give you an example. Our self-storage team, I had a couple of investors in my network who introduced me to this team, and they had done 11 deals with these guys and couldn't say enough good things about them. That's a good start. When you can get that kind of feedback from someone who's done multiple deals with these guys over a long period of time, and they're just singing their praises, it's a good start. I mean, obviously, there's a whole bunch of stuff that I do after that. But those are probably the number two things. I mean, the number one and number two things is track record, and then having somebody that you know, like, and trust that's done business with those people. You cold call me, you're probably not going to get my, you're not going to get my attention. If you've been in my network, I know you, and you've done business with someone for 10 years, I don't really care what the asset class is. But you've done business with them for a long time, you've had a lot of success with them, that counts. Anyone else? Yes?
Can you talk more about captive insurance?
Captive insurance, yes. I'm trying to make this as simple as I possibly can. Let's, all right, let's do something here. There we go again. Let's not do that. All right, so let's say that, all right, let's do it like this. All right, this is my company. This is my active company. This is my insurance company. My insurance company, this is a real insurance company that I own. My insurance company sends an invoice to this company with an insurance premium. This company pays into this company. This company collects the insurance premium. The insurance premium sits in this company tax-free. So let's say you sent, my captive insurance company bills my active company $1 million for insurance. You not only get the insurance benefit, but now you get this became a cost to this company that's now tax deduction. The $1 million sits in this company. There's two things you can do at that point. You can now take the $1 million out of this company after it having been in there for a full year and get taxed at capital gains rate. Or the way that we use it is we use this company as a bank and we borrow that money back out. Now it's tax free forever. So you're creating a cost over here, you're holding the money over here tax free, and you're borrowing out of that company. Now it's got to be treated like a real loan. You want to have a legitimate company that's helping you do this. You said, if this is a real loan, you move the money out of there and you set up your you set up auto pay and you amortize it over 5, 10 years, whatever. But it's highly regulated. You want a good company. You don't want to do this halfway. It's a real deal. If you do it right, you can save a ton of money in taxes. Everybody understand that?
Yeah.
All right. That's been a real valuable tool for us, and we've done that for a couple of years now. And it works well. Any other questions? Yes.
You're doing all 506Cs, and what's your range of commitments?
Mostly,
Really crazy high.
almost all 506Cs, and normally sometimes I don't know. So 506C basically means we can only accept accredited investors. Done for one more? All right, well, thanks for having me.
I have a follow-up on the
Go ahead.
You're saying the insurance company is, that's an actual legitimate entity. What's the barrier of entry to creating that insurance company? Specialty regulations in the state? How involved is it?
So on our part, we're not super involved. I mean, we're not involved on a daily basis. We're not involved on a weekly basis. But we have a really good team. We have a really good captive insurance team, to be honest. So they're doing all the regulatory stuff. They're doing the reporting. They're setting up the loan documents for us. They're doing all that stuff, and then they're doing internal audits to make sure that we're doing it right. So one of the things that I want to mention to do this right, get it to the point where you can do this and be effective. You need to have sales somewhere in the neighborhood of $5 to $8 million annually. So if you have a company that's generating $5 to $8 million, then it may be worthwhile checking it out.
Thank you.
Yep. So tax saving, I mean, this is near and dear to my heart. I started down this path because if you remember, I had a tax problem. So I love this stuff. I love being able to go out there and generate revenue, but probably what's even more fun for me is keeping what I earn. So keep what you earn or go out there and generate revenue. Either one is cash in your pocket. So I love this stuff. All right. One more. Last call. All right. Thank you.